Imagine waking up one morning and realizing that the money you worked so hard to earn, save, and invest has been quietly shrinking. Not because you spent it, not because the stock market crashed, but because something invisible has been slowly draining its value every single day. No alerts, no headlines screaming danger, no obvious warning signs. Just a silent force operating in the background, reducing your purchasing power, weakening your future, and making your financial goals harder to reach. That force is inflation. And for most people, it's the most dangerous wealth killer they never truly understand. Let's make this real for a second. Think about what $100 could buy you 10 years ago. Groceries, gas, maybe even a decent dinner out. Now think about today. That same $100 doesn't stretch nearly as far. Prices have gone up, but your money hasn't grown at the same pace unless you've actively done something about it. That gap between rising prices and stagnant money value is where inflation quietly wins, and most people lose without even noticing. Inflation at its core is the gradual increase in the price of goods and services over time. It's often measured by indexes like the Consumer Price Index, which tracks how everyday expenses change. On paper, a 2% or 3% annual inflation rate might seem harmless. In fact, central banks like the Federal Reserve often aim for that level because it signals a growing economy. But what most people fail to realize is how powerful compounding works in reverse when it comes to inflation. Over time, even small percentages stack up and erode your purchasing power in a big way. If inflation averages around 3% per year, your money effectively loses about half its value in roughly 24 years. That means if you have $10,000 sitting idle today, doing nothing, it could feel like just $5,000 in terms of buying power by the time you retire. And that's assuming inflation stays moderate. When inflation spikes, like we've seen during certain economic cycles, the damage accelerates dramatically. Now, here's where things get more interesting, and honestly, a bit unsettling. Inflation doesn't affect everyone equally. If you're earning a fixed salary and your income isn't keeping up with rising costs, you're falling behind. If your money is sitting in a low-interest savings account earning less than the inflation rate, you're losing money in real terms every single year. Meanwhile, those who understand how to position their assets through stocks, real estate, or inflation-protected securities often come out ahead.